afternoon, everyone. Whether you're in Quebec, maybe you're somewhere else, you're in Minneapolis, you're around the world, thank you for joining us today at another great session in partnership with Investment Quebec and the Quebec Government Office in Chicago. We've got a fantastic discussion teed up for today on a topic that I know is near and dear to my heart and many hearts, which is the topic of finance when you're entering the US market. Got a fantastic group of panelists to give us a conversation today, help us learn a few things, including a colleague from JP Morgan who is based right in Quebec. But before we get started, I'm going to ask my partner in all of this activity and my colleague, Roch Paquette, to say a quick welcome and I think tell us a little bit about, Roch, where you are right now.
Bonjour, Frank, and hello to everybody. I'm with Christophe Manès of Québec Invité in the FISC of Quebec City. The FISC is the International Forum on Health held in Quebec City every year in December. Bonjour, Christophe.
Bonjour, hi.
So it was a great success. We're very happy to be broadcasting from the FISC in Quebec City. Very happy to have so many participants today. Merci à tous d'avoir participé. Je suis avec Christophe Maes de Québec Invité au Fisc de Québec. We do invite you to come to Quebec City and see the exciting life science sector that is here in this beautiful European city in Quebec. Thank you, Christophe.
Thank you too. Hi.
I'd like to thank Medical Alley once again for this partnership and putting together these workshops. Thank you also to Christian, may I say, instead of Christian, because his French is quite good, and Michael from JP Morgan to be here with us today. Speaking of JP Morgan, I would be very sad not to say that we are organizing events at the JP Morgan Week in San Francisco this year. Although the events we are organizing are virtual, we have two trade missions that will be going to the Biotech Showcase and to RESI in San Francisco. We have some really good deals for the Quebec companies that would like to participate in that. So I do invite you to communicate with me or to look at my LinkedIn page where I did put the post explaining the interesting packages we have for Biotech Showcase and RESI. Thank you all so much. Merci à tous. Je vous invite à participer, à avoir une très belle session. Et comme je le disais un peu plus tôt en anglais, nous avons de très beaux forfaits disponibles en ce moment pour des événements de financement aux États-Unis qui tournent autour du JP Morgan Week, traditionnellement la première semaine de janvier à San Francisco. Alors, nous avons des forfaits cette année pour RESI, Redefining Early Stage Investment, et pour le Biotech Showcase. Allez voir ma page LinkedIn ou écrivez-moi pour connaître nos forfaits. Thank you so much to all. Have a very good workshop.
Roch, thank you so much. We appreciate it. And yeah, I have to say, I know it is almost the end of the year and almost the start of the next year when I start seeing all the conversations about the JPM conference. It also makes me feel very good to know that it is still a thing and that it's a little bit of normalcy coming back in still this challenging time. I'm going to get us started on our discussion. We've got a really important topic here, and we've got probably two of the best people that you could find to help you get better informed about bringing your company to the US market, but especially how you finance that, how you manage that, so that you can be a successful business. I'm joined by a longtime friend of the association and Mike Giedel, who's the managing director for the healthcare and life science business. And then his colleague, Chris Barrow, who's up in Quebec. And Mike, I'll hand it over to you to get started. Folks, there's a Q&A function down there. As you have questions, throw them in the Q&A. I'll be moderating that. I'll pull them into the discussion. Just start typing away as they come to mind. And Mike, with that, over to you.
Great. Thank you so much, Frank. And thank you, Roch. Really appreciate it. Appreciate being a part of this and having an opportunity to present to you guys today, just along the options to finance your company as you think about moving into the United States. So I'm going to be sharing my screen. We're going to go through a quick agenda, and Chris and I will be focused on talking through the different aspects of finance. So I've been told that we've got some early stage companies on the line, as well as some later stage companies all the way through. So this is for everybody. fine to get into the weeds as needed, and we can do that through the Q&A, but we will really be high level at this point in time around the different types of financing structures that are out there, and look forward to a really strong question and answer session going forward. So give me 1 second, I'll share my screen.
Oh, perfect. That's looking great.
All right, can we see that now?
Yep, it's in full screen mode and looking good.
Fantastic, wonderful. So again, really appreciate the time. My name is Mike Giedel. I lead our life sciences and healthcare services practice for the Midwest United States as well as Canada. I've had the great opportunity to spend a number of years calling into the Canadian space, particularly in Toronto and Montreal, and have started to build that ecosystem out. We hired Chris Barrow earlier this year in 2021. He relocated from Philadelphia up to Montreal, where he is from, and is now going to be leading our life sciences efforts as we continue to penetrate the market and help companies like yourselves grow and get access to different opportunities within the United States. I've been with JP Morgan for 20 years. I am based in Minneapolis, Minnesota, and have been really working within the healthcare space for the last 11 years, specifically focused on the life sciences space for the last 6. And again, really look forward to showcasing what we have to offer today. I'm going to flip it over to Chris to introduce himself as well.
Bonjour à tout le monde. Je m'appelle Christian Barrow. Hi, everybody. I'm Chris Barrow, as Mike mentioned. I moved from Philly back to Montreal, my hometown, this past summer. I'm very pleased to be leading our efforts in Canada and trying to replicate all the success we've had in the United States. Si vous avez des questions, si vous voulez me rejoindre plus tard, je vais essayer de répondre en français. Ça fait longtemps que je n'ai pas parlé en français, alors j'essaie d'apprendre et comment dire ça, trouver des mots pour m'expliquer. Alors, very nice to meet everybody and looking forward to a great conversation today. Please, this is interactive. We want as many questions as possible. We're here to help you in any way we can, and there's no bad question. So please don't feel free to raise your hand and ask Mike and myself the questions.
Great. So we'll move on to the next slide, and I will go through what our agenda is going to be for today. Really, when we think about life science organizations, we think of 2 bifurcated groups. One is strictly R&D that is focused on getting through their clinical trials and pilot studies, particularly on the device side, and then commercial stage, right? And so we're going to talk through what happens in the R&D stage, what traditional financing looks like, all the way from angel investing and friends and family through to IPOs and potential SPACs, and then some alternative financing as well. And then we'll talk about the commercial stage organizations, and we break those down between our cash flow negative companies, so companies that maybe have gone through an FDA process or Health Canada or EUA process, and then really focus on how to grow that business into a cash flow positive type of organization. And so there are different types of financings that are available to those different types of companies. So with that, I will start with Chris talking through traditional financing in the R&D stage.
So we think about R&D stage, we break it down between 2 different groups. We break it down first as early stage seed companies. These are the companies that are being formed coming out of universities. You're translating your science from the university, or in your garage or your lab, you've created a new molecule, a new device. And this is when you're trying to bootstrap. Do you really bootstrap? So where do you seek your first capital? Obviously, it's friends and family, unless, and this is in a rare circumstance, you're known to the community, the institutions, and they know who you are and you've had success with them previously. Then they may come and say, hey, we're happy to to fund your company. But for most part, it's friends and family. And typically in this kind of structure, the founders are getting common shares, and so the families probably getting common shares as well. Some folks may say, hey, we want something different, and we can talk about what we call a convertible note. Mike, can you scroll to the next one, please? So this is where the next source of capital is angel investors. And who are they? Angel investors are usually high net worth people within the community that have some knowledge of the life science space. You really don't want to be targeting angel investors that don't know anything about life sciences, because they won't understand the time it takes to go from zero to commercialization and how much capital is required. Their expectations may be disappointed in that you're not getting to a commercial product as soon as you would think in a non-life science company. So the angel investors, we would encourage you to think about those who've had some experience in the space. The type of investment vehicles that angel investors are looking for, and that we would suggest, is some kind of convertible note. And a convertible note is an instrument where is a short-term note that will convert into equity at some period of time, and usually that is at the next round of financing. And why do we suggest a convertible note? We suggest it because, one, it's much easier to paper. In other words, it's easier in terms of legal documentation. Two, that means the costs for the company are lower. And three, there's a little bit of fluidity in terms of valuation. And fourth, you don't have to go and issue more shares and recapitalize the company. Now, the thing that you got to note about angel investors, they're going to do their due diligence, and it is always a success to get angel investors. But the success that you have in raising capital from angel investors sometimes gets false sense of security and false sense of confidence, and when you come to get money from institutions, you're surprised at the rigor and of their due diligence. So be forewarned. Yeah, it's great to get angel investors, but look, you'll have to be more prepared when seeking more institutional investors. Mike, can you move on to the next one, please? Thank you. So as you're moving down the paradigm, right? So like in what we call the seed round, you're going to raise from anywhere from, say, $0 to $3 million. Another source of funding is family offices, right? And what are family offices? Family offices is a wealthy individual, wealthy family says that we're going to put aside some of our money to invest in different types of investments. And typically when a family office is investing in life science companies is because they have some kind of connectivity to the disease or the treatment or the affliction, because somebody within the community of their family that they know well has that disease. Again, the nice thing about family offices, they tend to be able to write decent sized checks, a little bigger than the angel investors. And both of them are going to be more like passive investors. So both the angel investors and the family offices, we recommend you don't need to offer board seats. You can allow them to take in the investment, but you don't need to offer board seats to garner their investments. Rak mentioned at the beginning that there's two events happening during JP Morgan, the Biotech Showcase and Resi, which is redefining early stage investment. Those events happen not just at JP Morgan, but 4 or 5 times a year. The group is based in Boston. They have a Northeast event. They have an event on the West Coast, and then they obviously have one during San Francisco. So if people are interested in that, Mike and I have connectivity with that group. We can make introductions and can tell you when the schedule is for those events. Mike, can we just move on to the next stage, please? So Institutional investors, when would you see institutional investors? Well, it's when you step from your seed, the product has moved down the timeline, and now you're thinking about a clinical opportunity. You've developed the product, you've developed the medication or the small molecule or the treatment, and you've progressed from in vitro into potential animal testing and into potentially IND enabling studies. So you need more capital, right? Because you've in the early stage, you've built out, you've got a few people on the management team, you spend a little bit of money in terms of your intellectual property, and now you're going to clinical trials, which are very expensive. And so this is where you would see a Series A, and the types of money you raise in the Series A, anywhere between $5 to $25 million, and that was going to require institutional investors. The
Hey,
thing about,
Chris.
yep.
We had a question, I think a simple one. A person had just asked, could you repeat the name of the group and events that you had mentioned? They had missed it.
Sure, it's called Resi, and it's called Redefining Early Stage Investment. So both myself, Rock, and Mike have knowledge of that.
Thank you.
Oh, no problem. So the thing about when you think about institutional investors, right, and a lot of our early stage founders worry about dilution, right? Because when an institutional investor comes in, they're going to say they're going to want to take a big chunk of the company, and founders are often reluctant to take that institutional money because they're worried about dilution, and it's a good concern. But I would tell you, I think it's better to own a small piece of a big pie versus a big piece of a smaller pie. That capital that you're going to get from those institutional investors are going to allow you to progress and get to further milestones and bigger valuations of the company. Otherwise, taking money just from angel investors and family offices, it takes longer to progress the drug or the device down the pipeline. The other thing that the institutional investors will think about is that they're not going to want common shares. They're going to want preferred shares. And why do they want preferred shares? Just like the word says preferred, they're going to want preferential treatment. They're putting in big investment, and they're going to want to get back the access to their cash if anything happens. So they're going to want to have first rights, and they're going to have preferential treatment. The thing that on the other from the side from the company, obviously you want to talk to as many investors as possible. And in an ideal situation, when you're leading this round, you're going to want to have multiple investors bidding to be the lead. Why? Because if you have multiple bidders, you're going to have a higher valuation, leads to lower dilution. The thing about institutional investors you need to think about, right, is yes, you may have interest from multiple companies, and it's not them doing due diligence on them and on your company. You need to do diligence on them as well. And the reason why you need to do diligence on them is because you're not just taking your investment for one time. You're partnering with this group. They're going to be there to help you with guidance in terms of governance and growth of the company, and they're going to be there through the growth of your company. And if you establish a relationship with the wrong party, it makes it very difficult to run the company. So when thinking through this, right? The thing that the shareholders, the VCs themselves will be thinking about, right? Like, what are the big things that they're going to do in terms of the rigorous due diligence? Well, the first thing that comes to mind, obviously, is the science, right? They're going to bring in their teams of experts, PhDs, MDs, and doctor candidates to examine the science, right? They're going to want to look at the methodology in terms of experiments. They're going to want to understand your clinical pathway, your regulatory pathway. They're going to want to understand the timelines, right? So when you go out to the VCs, you have to have that set in stone, or not set in stone, but you have to have had that thought through thoroughly, right? They're also going to look at the team. Who is the CEO? Has the CEO had any experience in doing this before? Has the R&D team, the chief scientific officer, what's their experience in taking a product from zero to commercialization? Now, a question that you should be asked, that we get asked a lot, do VCs support early stage CEOs? CEOs who have never done it in the first place. So CEOs who are professors at universities are now, running a company. It depends on who you ask, right? Some big VCs say, yeah, we prefer to have a brand new CEO because they're hungry, and others, you hear the expression, they're banking on the jockey, right? They've made money with the CEO in past, and they're going to support them through the next endeavor. There's no right or wrong answer. It just depends on who you're talking to. The other thing that the companies are going to think about beyond the science, beyond the team, is who the stakeholders are. They'll want to talk to the physicians. They're going to say to the physicians, do you know this product? Do you understand it? Does it make sense? Is it better than the standard of care? Would you adopt this product? They're going to talk to the providers. Are the providers going to say, yes, we know what the product is? Are we going to think about reimbursing this and bring this under coverage? They're going to look at the competition. They're going to say, who else is out there? Where do you fit in this paradigm? They're going to want to look at the addressable market. So they're going to look at both the addressable population, like who are the people that are going to receive the medication or the treatment, and then they're going to drill down even further and say, what is the addressable market? Well, where do we fit in the paradigm of the treatments? How often will we be able to provide our treatments? What is the cost of us providing that treatment? And then what do we think the maximum revenues that we can generate from this? And that means there's a lot of work that needs to be done prior to talking to the VCs. Now, as a CEO, the difference that from moving from academia to being in the business world is you're always thinking about capital. Once you've closed the next round, your last round, you always have to be thinking about raising the next round. It doesn't stop. And the last thing I will say, it's not on this, right? Another source of capital at this time is services for equity. What is services for equity? So in the clinical stage, you're going to have to hire a clinical research organization to run the clinical trials on your behalf, right? Because that's what the regulators are going to want to ask you to see a third-party company run the trials to provide validation of your data and protocols. And so sometimes, cash-strapped companies think about, if I provide equity to my CRO, they'll be able to provide that service. And so that solves some of the gap. The two things I would caution to you is that you need to understand if you have a methodology to make sure that you can separate their investment from the services and the timelines that they've guaranteed. And two, if there's any kind of dispute, there's a way to break up the contract and move on. And then what happens to the shares or equity they were supposed to receive? I will stop there and see if there's any questions.
Yeah, Chris, there was a question from the audience, one I've heard quite often, which is there a minimum amount of capital that you need to ask for before a venture capitalist will take you seriously? They're wondering, like, if they were only raising 500 grand, is a VC not going to take them seriously?
Well, it's not a matter of taking them seriously. What it is look, it depends on the level of the VC. So let's take example an NEA, right, based in Washington, D.C. They have multiple funds, and the most recent fund, they raised $3 billion. So they have to deploy a lot of capital to a lot of companies. So they may like your company. It's not that they don't take you serious, but making a due diligence for a $500,000 investment or a $25 million investment is going to be the same due diligence for them. So it's not they don't take you seriously. It's just that they can't deploy that little amount of capital. So it just depends. And you just need to understand the size of checks that the VCs are wanting to write.
Wonderful. Thank you.
Yeah, Chris, that's exactly right. it's really important to know what series the venture capitalists are playing in. There are seed funds out there that will happily write $500,000 checks for your business, but they're seed funds. You can't go to, like Chris's example, NEA, New Enterprise Associates, and say that. They're going to say, you know what, appreciate it. Let's talk when you need to raise a significant amount more capital and you're a little bit more de-risked. So in those cases, very important to know your audience, to know who those institutional investors are, to know, are they seed funds, Series A funds? Are they later stage funds? Are they crossovers? Like, what is it? Because it's really important that we don't, and I don't want to say waste their time, but we need to understand exactly how much capital is being deployed typically out of these funds, and at what check amounts. So that's a really important question to be asked, and I'm glad somebody asked that.
One more question had come.
Sorry, go ahead, Frank. Sorry.
One more question coming in. I'll word it as, what's your view on safes as far as a structure, or can you comment on that? I know that gets into a more particular way of doing a deal, but what would be your commentary on safes?
I'm not familiar with safes. Are you, Mike?
Yeah. So safes are actually a very popular way for early stage investors to raise capital. Right. You raise your cash. It eventually turns into equity. I would say that is that's a fine way of starting out with raising capital, and a lot of early stage companies do that.
Thank you.
Frank, can I just add one other note, right?
Please.
So when you're raising the seed fund, right, and you're talking to angel investors, right, in the US, I'm not so familiar with Canada, but in the US, there are groups that have forums that attract simply angel investors. There's a big angel fair in Philadelphia that happens in the fall. There's a group called Keiretsu that has events on the West Coast again in Northeast, and basically what it is it's a group of high net worth investors. They sit down and they listen to pitches, and based on those conversations, there's follow-up conversations, and I've known companies to have been able to raise between $250,000 to $1.5 million through these forums. So again, but you in these situations, the investors are probably looking for the companies to have some kind of location facility in the US.
Wonderful, thank you.
Mike, it's up to you now.
Great. So when you receive institutional venture capital, a lot of people start thinking about venture debt. And is venture debt for me? Does my board feel like we need to utilize venture debt to continue to extend the runway for our particular project or our asset, which is non-dilutive, and give us more traction to be more de-risked before we have to raise our next round? And hopefully our next round will then be priced at a much higher level than it was previously. That is very common. In fact, venture debt as a strategy has increased significantly over the past 10 years, particularly as more companies are receiving institutional venture capital. In the friends and family, angel and family office side, you're going to be locked out. Like, you're not going to get venture debt. It's going to be very, very difficult. Banks look at three things when doing a venture loan, and Chris talked about all of them. It's kind of the same things that these institutional investors are asking for. But one is, particularly for the banks, is who is that institutional investor? And what is our relationship that we have with that firm? So if we're talking about a company, for example, company gets backed with capital from Arch Venture Partners, and we have a very strong relationship with Arch, and they and their board decides that we want to go out and look at a venture debt product. We will do our diligence on that particular name, Arch Ventures, and we will say, okay, we know 5 of the managing partners. We've worked on 3 deals with them in the past. They've all gone swimmingly, or in the case of those that have gone under, had a bad flip of the card. They have worked with us to pay back their venture loan, and we were made whole. So those types of experiences drive what venture debt does for us. So in addition to looking at the institutional capital provider, we are also looking at, to the same point as these institutional investors, differentiating multifaceted technology with a significant total addressable market. So is this a one and done type of asset? Is this a single asset platform, or with no platform whatsoever? Is this a single device that has a TAM of $100 million, but you're looking, but you've only raised $10 million and you're looking for venture capital to supplant some of that? That's going to be a little more difficult than a company that has multiple shots on goal from a biotech perspective, or has multiple devices and different types of technologies focused on those devices, where they're reaching out to the cardiovascular market or the neuro market, or they're focused on CNS or oncology, and where those total addressable markets are in the billions. And based off of what they've just raised from these institutional investors, we get very comfortable around what that addressable market is, to know that as this company continues to grow, they're going to and they continue to be successful, they're going to be able to raise significant more sums of money, and we'll be able to continue to follow that story and grow with them. The third piece is management. The management is very important. What does the operational leadership look like? What does the board look like? Board is really important. In addition to, what does your scientific advisory board look like? Are there strong scientific advisors on your team? Are they the top KOLs in your space? Do they validate your particular asset or device? Is the CEO someone who is from industry already? Did they come from a large strategic? Did they, are they an academic? What's the relationship between the operational management team and the institutional investor? So those 3 are really important things that we look at from an underwriting perspective of when we're doing venture debt. When we look at venture debt, it's really based off of a percentage of the capital raised. It's usually a maximum of 30% of what is raised. So if a company raises $30 million, we could go out and do about $9 million of venture debt on top of that to help continue to extend that runway. We can tranche venture debt. So tranche just means that as money comes in, so a lot of these Series A and Series B deals are tranched, meaning that you get a certain portion up front, and then as different milestones are met, they release more funds into the company to be utilized. And we can structure those the same way, tranched based off of what dollar amounts are coming in, again, from those institutional investors, based off of the milestones that have been discussed previously. So there's usually some kind of interest-free period between 12 and 24 months, basically saying, look, we want you to spend your time with this cash building your business versus paying down this debt at this critical juncture. Covenants are tied to milestones at this point. They're not tied to any type of real financial metric because there are no financial metrics. It's a cash burning business. There's no revenue. There's no EBITDA or cash flow. And so we tie them to milestones based off of clinical successes. So if you're in a phase 1, well, it's going to be determined off of the results of that phase 1. Okay, and having a conversation then with the FDA on what a protocol looks like for phase 2, and other milestones such as that. Again, it is non-dilutive, but again, venture debt is very selective. very selective based off of who that institutional investor is and what type of relationship the bank has with that particular institutional investor. So I'll stop there for a minute and see if there are any questions around venture debt.
We don't have any in the Q&A function on venture debt right now.
Okay. Very good. Well, if you think of any, we're happy to answer them. We'll move on to the next piece of funding that happens after institutional venture capital. So as you're starting to think about, particularly for the companies in Montreal that or in Canada that are looking to grow into the United States, it's really important, particularly on the biotech side, to get some crossover funding. Well, what is crossover funding? What is a crossover investor? Crossover investors are late stage investors that typically participate in the public equity markets, but they cross over into the private markets to look at very promising pre-IPO assets. So I will tell you that the last 30 biotech IPOs that went public, 29 of them had some type of crossover investor. Crossover investors are very large. They are usually hedge funds or very large, almost private equity funds. But these organizations have just a stable of analysts, and all they do all day long is look at life science opportunities. A lot of these folks have PhDs on staff. They're very, very smart, and they are putting significant sums of money to work. So think about crossover funds like Fidelity, T. Rowe Price, Vanguard, specific to life sciences, RA Capital, Wellington, Perceptive, Deerfield, SoftBank has become very active in the marketplace as well. But these are companies that validate even more what the science is, who the operating partners are. It really will help you get to an IPO. It'll make it easier for you as an owner or as a CEO of a business to go that IPO route, because these companies, not only will they put in $60 to $100 million into your Series C or Series D, they will typically buy a large portion of your IPO, at the price before market. Very important on the biotech side. We don't see a lot of crossovers on the medical device side. That's usually because the medical device side, before they go through an IPO, is already commercialized, and usually you can see adoption and reimbursement, which is really, really important for any organization that's going to go public as a device company. You have to show the adoption. You have to showcase the reimbursement. Otherwise, you're going to, quite honestly, be a little bit dead in the water. Any questions on crossovers at all?
There are not.
Right. Lastly, we'll talk about IPOs and SPACs, and this is really focused exclusively on the biotech sector. Biotechs can go public as early as preclinical, but most of them are in that phase, after phase 1 into phase 2 type of life cycle where they're at. So again, with IPOs, an IPO is just an additional way of raising capital, right? Instead of going to a bunch of institutional investors and continuing to keep this company private, you test the public market. And when you test the public market, you are no longer stealth. You're dealing with the whims of what the market is doing on any given day. You can be pulled down because of a particular negative announcement by a large pharmaceutical that you may have some type of tie to, because you're in oncology and they had an oncology asset that failed. And so, it's really important for folks to understand that when you do an IPO, there's a lot of work that goes involved into it. It's expensive. It's very important. You need to professionalize the finance team, the accounting staff, your law firms. These are, all of your good, bad, and ugly press releases will be revealed on a quarterly basis to all shareholders. Again, you're subject to public sentiment, and like on the positive side, it is easier to raise follow-on offerings because of that. And a follow-on is basically after you do an IPO, hopefully you get a pop in your stock price, and 6 months down the road, when you're going to start your phase 3, you have the ability to showcase new data, and that new data is a catalyst for raising new funds at a higher dollar amount or higher valuation, and it's easier to do a follow-on round at that point. Any questions on that?
Yeah, Mike, one question. And you started talking about a little bit of the positives for smaller companies that may go and list on, say, one of the more regional exchanges versus like a NASDAQ or an NYSE. What's the good and the bad of that? We've seen a number of companies, biotech and some device, that they'll do like a TSX and ASX. Can you talk a bit about kind of the trade-offs there, or is it the same?
It is the same. If you go public on the TSX, you're not accessing the healthcare market, right? There are some healthcare names on the TSX, some larger healthcare names, but for the most part, you're going to get your very large institutional buyers on the healthcare side in the United States on the NASDAQ. That's really it. Like it's TSX and ASX. They're great exchanges, and I wouldn't say no for that, but I think that you should really make sure that you've done your diligence on the exchanges and understand, like, are these retail investors that you're talking about? And retail investors can change on a whim, as we see, with all these meme stocks out there. They can go up and they can go down very quickly. Or do you want to be focused on institutional buyers who believe the story, who are going to put their money where their mouth is, continue to support the organization, and those things? And you can get that on the TSX and ASX, but it's not as robust as what you would see on a NASDAQ listing.
Wonderful, thank you.
Can I just add? So the TSX is not a bad vehicle. It's another source of capital, which is always a hard thing to get for life science companies anyways. The issue is the size of the raise, right? So on a TSX, the raises, especially on the biopharma biotech side, are smaller. So say you raise $10 or $20 million. Mike and I know that to get a drug approved through any of the regulatory boards is going to cost you roughly $250 to $500 million. Right? So if you raise $10 or $20 million, it's a much smaller tranche, and it's going to just take you longer through the through the TSX to raise the amount of capital you need to get the product through clearance. That's why as companies grow in Canada, they should start seeking institutional investors globally that have big wallets and big checkbooks to write. And Mike is right. The longer you can stay private and not have to go through the regulatory process in terms of SEC reporting and quarterly reporting and paying for audits and paying for the lawyers to submit all the regulatory requirements to be a public company, it's better. And you can focus on the company and focus on the development of the drug or the device. So not a bad alternative, but not ideal either.
Agreed. So now we'll talk just quickly about some alternative financing strategies for R&D stage companies. So you guys in Canada are very lucky. You've got a phenomenal federal government and provincial governments that are investing significant sums into the innovative economy sector. And because of that, you've got lots and lots of opportunities and lots of buckets that you can choose from to get non-dilutive grant funding. In the United States, you can get grants from really two places. You can get them from the National Institute of Health and the National Science Foundation, and then Through that, you can also utilize what we call our SBIR, or get Small Business Innovation Research Program, or the Small Business Technology Transfer Program, which Chris was talking about earlier, where in phase one with this, it's called an SBIR program. Phase one for the SBIR program is $50,000 to $250,000 for the first 6 months. And then phase two is usually around $750,000 for 2 years, but it goes all the way up to about 1.8 million. The catch is it has to be at least 50% owned by one or more permanent residents in the United States, and it has to be located in the United States. So you've got a lot of companies that want to move and start a US headquarters in the United States. It's important that you have somebody as part of the ownership team, if you want access to these SBIR grants, that has some type of US permanent resident status. So that's really the important piece. We do have state and local government aid that's also provided to these companies as a way to get them to kickstart their innovative economies and startup scene. But those vary by state. So I can't really talk deeply about what happens state by state around that. Rock would be probably pretty good at that, or maybe the state of Illinois, and then you know, others could be very helpful on the government side. So, any questions on the grants? Okay.
All good.
So the next piece is really non-dilutive partnerships for asset development. And that, again, this is really focused on the biotech side. So for all of our medical device and diagnostic partners, apologize, but this is where it gets really interesting for early stage and later stage R&D businesses. So as you're developing an asset and you start to showcase positive data, you will probably start to get calls from some of the big pharma companies that are looking to fill some gaps within their portfolios because of you know, patent cliffs that they're running up against or other thing, and they want to partner with you. They will say, we will pay for your phase 2 trial. We will give all this money to you up front. We want to partner with you for this particular asset that focuses on this piece of oncology, and with the hopes of that next flip of the card is even better data, even stronger data, and then they will partner again, continue to build out that asset, or in some cases they will buy. They will just try to buy it outright even before it is, even before it's commercialized. And so these are really good because, again, you're getting your trials paid for upfront. You don't have to raise any additional dilutive capital, and you've got a potential partner for life, particularly if you have a platform of assets that you're developing. So very good opportunity there for strong assets to do some partnership with big pharma on that end.
Hey, Mike, we had a question come in on the NIH side and probably related to the SBIR piece. They're wondering about, can you get the grants if you establish research collaborations with groups in the US? So I would assume a company in Canada, they get a partner in the US and then go for the grant.
I think the partner, and Chris, maybe you know more about this than I do, but I think the partner can ask for the grant.
Yeah, exactly. The partner can ask for the grant, and then you have to be careful where the research is being done, right? The partner can't be hiring the Canadian company to do the research and then claiming the grant, right? The research has to be done in the States, and so it gets tricky. Again, Mike and I know consultants who know this space really, really well. There's a whole cottage industry that all they do is help companies write grants, navigate the NIH and NCF and even the Department of Defense. It's a labyrinth of dollars out there, a lot of dollars, but it's complicated.
Thank you.
Okay, moving on. So in addition to the non-dilutive partnerships, you also can get strategic investment. So part of the overall financing of a business, many companies really seek validation through a strategic investment from a larger player. So that's equity. That's equity participation from a strategic partner. So on the device side, it could be Medtronic, it could be, you know, Boston Scientific, Edwards, et cetera. On the pharma side, it could be any of the large pharmas, Pfizer, Merck, Bristol Myers, et cetera, where they're coming in, but they're actually taking equity. So they're not partnering. They're actually coming in. They say, you know, this is a really interesting, differentiated asset. We are going to invest in this because we think it is important. And so you get that, right? So, and what do the strategics get? Well, they get a look behind the curtain early, right? They get to see early access to data. They get to really understand how strong and how differentiating this particular asset is, and they can decide whether or not they want to continue investing at the end of the day. So they don't, you know, when strategics invest, they don't necessarily buy the company outright at a later date. Many times they do. An example of that, particularly in Canada, would be the Trillium purchase of Pfizer. So Pfizer came in and they had made an earlier investment in that business, and a few months ago they decided to buy the whole business outright because they liked the data enough to do that. So that's an important piece of financial structure, particularly as you're getting closer to commercialization.
Mike, can I just interject and say one thing, if you don't mind? So look, a lot of people say, "Hey, we got Pfizer, whomever, to collaborate on our top asset," and I would just caution and think about that twice, right? Because if you allow them to partner on your best asset, what's left for the rest of the investors? So it's one thing if you have a platform and you have five small molecules, and number 5 is where you're allowing to collaborate. Fine, you take that non-dilutive funding and pour it into your other molecules. But if you give away the first asset, your top asset, then what is left for the investors? And what are the VCs going to come in and invest? They say, look, you already gave away your best asset, and now we're left with the last 4 that we don't know where you are. So be very careful on how you structure these things.
Yeah, Chris, that's a good caveat. I was talking more along the lines of those platform types of companies where they've got 6 or 7 shots on goal, and they're partnering a few of them and developing the rest of them with that cash. The last one, which is really, I would say is an interesting one, and one that we've seen a lot more of lately, is pre-revenue asset-based lenders. So these are companies that will say, okay, we're talking to an early stage business. They've raised funds from, you know, a sizable family office or a seed fund institutional investor, and they need to use those funds to build their assets, but they also need to buy lab equipment, and they need to buy computers and other types of technologies, hard assets, right? And there are groups out there that want the hard assets really, really badly. So they will compete. They will provide term sheets. They will, you know, look to give you additional capital while you're still cash flow negative or burning cash, right? And so these are another way to go out, and instead of utilizing that very hard-earned equity check from one of your investors to pay for lab equipment, now you can get it on a loan basis where, you know, that lease residual is really what those companies are after at the end of the day. So a really interesting and important piece of the capital structure there. And we know a number of folks in that space. So if you're looking for something like that, we're happy to help and talk as well. That's it on the R&D stage side. Any questions from our R&D companies before we move over to the commercial stage? And I know we're running up on time here.
I think you are okay.
All right. So when we look at the commercial stage, I'm going to go through the cash flow negative companies. Chris is going to talk through the cash flow positive side. So again, we talked about venture capital already, including strategic investment. these are companies that are, again, they made it through the FDA process, right? They made it through the FDA. They're no longer an R&D company. They've now got to ship to a sales business, right? And so now they've got to figure out, well, what's my sales and marketing staff going to look like? What's my budget going to look like? Do I need to hire several directors? Am I going to go direct, or am I going to use a distributor model? And so all of these things are contemplated at the board level and at the operational management level. And you need to have those strategic discussions in order to showcase, okay, to get fully commercialized and to build this out across the United States, I'm going to need X millions of dollars to do this. And I need to hire 150 salespeople to hit up all of the doc practices within the United States in order to sell my particular device or my particular pharmaceutical asset. So that's really important. And venture capitalists will happily put money in. And so will partners, strategic partners, right? So if you're already talking to Pfizer or you're already talking to Medtronic and they really like your asset and they don't want to buy you yet, they will still continue to put cash into the business to help you get to where you need to go from an adoption perspective, from a growth trajectory perspective, before they say, okay, you know what, they really do have this adoption. I'm going to buy them before they grow even more and the valuation is too high for us to purchase this company. The other thing is growth equity. So there are a number of venture capital firms and private equity firms that have growth equity arms. And this is specific for companies that have revenue. So these folks are specifically focused on helping with reimbursement, helping on the regulatory side, helping with the sales practices and sales management, because all of the companies that they have in their portfolios are cash generating, are revenue generating, but still burning cash. So they're early on in their commercialization life cycle. Growth equity really helps to spur continued growth at a faster pace, which can lead to a faster IPO or a faster M&A at the end of the day. We talked about venture debt. This is a great opportunity to utilize venture debt again. It's still considered venture debt because it is a cash flow, a negative business, but you can call it growth debt as well. I mean, this is debt that's utilized to really extend that runway to get you to cash flow positive, right? And once you're cash flow positive, then you can start doing the things that Chris is going to talk about for traditional lending, which our bank specializes in specifically, in addition to the venture debt side. One of the things that you can do, which is different than the partnership side. So again, this is going to be more focused on the biotech side. Licensing of your asset. So your asset's still 100% owned by you, but you're licensing the rights to a particular, let's call it a particular geography. So you are going to say, I'm going to keep all of the rights for this product for the United States, but all of my outside United States rights, global rights that I have, I'm going to start to license them out to specialty pharmaceutical companies or to other pharma companies. And what you can do there is then you start to develop royalty streams, right? So instead of you having to go out and build a sales force in Europe or in Japan or in China, you can utilize somebody else who already has that sales force built out and let them sell your product for you, and you take a royalty on the back end, right? And by doing that, you get an upfront fee from, or an upfront investment from these pharmaceutical companies or specialty pharmaceutical companies, and then a royalty on the back end, which leads me to the next part is royalty financing. So there are a number of organizations out there that will do royalty financing. Certain groups like Royalty Pharma, DRI, Sagard in Montreal, they have royalty financing, royalty purchasing programs in place where they will go and they'll talk to a pharmaceutical company or even a device company that has cash flows, and they will buy those cash flows at a discount, and they will provide you upfront financing for that, so you can utilize that cash to work on another asset or bring your next asset that was preclinical, bring it into the clinic and start to do it all again in maybe another indication. So royalty financing is something that is utilized quite frequently. And it doesn't matter if you're cash flow negative or cash flow positive. It just matters that you've got adoption in the market, you actually have sales, and you've got a product that has a potential to be a blockbuster, but you're just not getting there yet. Any questions on that? The last again is the IPO side. There are many companies now that can go public. Medical device companies will clearly go public. They've got a lot of traction and a lot of adoption on their particular device. They've got a large total addressable market, but they're still burning cash because they're continuing to grow at a very fast pace. Great opportunity for an IPO or to utilize the SPAC process. And again, follow-ons are the same once you do an IPO. That's really where you go from a financing standpoint as a cash flow negative business. I'm going to turn it back over to Chris to talk through what we do with cash flow positive organizations. So Chris, take it away.
Thanks, Frank. Thanks, Mike. You've now progressed through being an R&D stage company. You gone from a cash flow negative. You built up a sales team. Now you're generating positive EBITDA. Guess what? All the banks come out. They're all calling on you now. There's none of the specialty finance companies talking to you. You have access to debt capital. Which is the cheapest source of capital that you can have, right? Because you're not giving up equity in the companies. You're just providing. You're borrowing money, and so as you progress from being cash flow negative into cash flow positive, depending on the size of the company and the size of cash flow you're generating, that means that the company itself, by itself, can go and borrow money, versus having to use assets or to use personal guarantees or things like. So what are traditional banks going to look at? Right? It's the what we call the 5 C's, right? They're going to look at your character. What's the history of the company in terms of past debt? What are the owners like? What have they done? They're going to ask you for capacity. Do you have the cash flow to repay the debt? They're going to look at your collateral. What accounts receivable, inventory, equipment, land do you have to support the loan in case the cash flow is not there? They're going to look at the economic conditions. What's the current economic conditions? If you try to get a loan in 2008, guess what? Very hard to get a loan at that time because of the recession. But you come out of the recession, economic conditions improve. Guess what? The banks are ready to provide loans. And the final thing is, how much capital have you actually put into the company? Have you raised any money, and do you have any skin in the game? So as you go out to the banks, what are they going to ask you for? They're going to ask you for a business plan. They're going to ask you for historical financial statements. They're going to ask you for projections, right? They're going to look at the competition. They're going to look at your budget to see where you're going and how do you pay for these things. They're going to look at news. They're going to see, is there any negative news about the company? Is there any negative news about the owners? What is the company's integrity? They're going to look at your customers. Do you have accounts receivable? Is there a concentration? What's the history of the payment? Are they delinquent in making their payments? And then, given with COVID these days, supply chain, they're going to look at your diversity of suppliers. So that's traditional single bank loans. You're going to have leases that is Mike touched about this on asset-based lending in terms of equipment. It's equipment finance, right? So everything from, you can lease your building, you can lease your equipment, you can lease software, right? And they're going to go through the same process. It's a capital asset that you have that you can now finance. So these loans can be from 0 to $100 million, whatever. The size depends on the size of the company, and what the banks are going to look at are your revenue and what they call EBITDA, earnings before interest and depreciation and amortization. That is the key cash flow indicators that they're going to look at. and they're going to look at they're going to have two kind of covenants, what they call a cash flow covenant and a leverage covenant. A cash flow covenant is simply, do you have enough cash to cover the principal and interest payments? And the leverage covenant is, how much debt do you have in comparison to the cash flow, the free cash flow you're generating? So as you move from a single loan, a single bank loan, you move into what we call the syndicated markets. What are syndicated markets? Syndicated markets is just a bigger loan, and that you have a group of banks that are providing the loan. And why are a group of banks put it on a loan? Because the size of the loan is so big that the one bank doesn't want to take on the whole risk of having that loan. So they get a group together. What happens traditionally is banks will compete to be what they call the lead bank, the ones that will lead the process. They'll offer a term sheet to the company. There's a back and forth negotiation with the company, and that term sheet is then used by the lead bank to solicit other banks to come in and participate. The covenants will be similar. The only thing that will be different is the cost will be a little bit higher, because there's an arrangement fee that the lead bank charges to solicit the other banks, and the credit agreement is a little bit larger because it has to encompass all the different types of things and complexities of the company and the syndicated bank. The big thing that's coming now is direct lending, right? What is direct lending? So direct lending is primarily for companies. When Mike talked about growth equity, private equity owned companies, they push the envelope in terms of how much leverage, how much debt that their companies take on, and the banks and institutions look at these private equity and say, well, these guys have been very successful in being able to have a portfolio, and these portfolio companies have been successful in being able to repay their debt. So the banks will say then, okay, we're going to have a single group that's just going to focus on these private equity owned companies, and they will take on more risk. And when it might take on more risk, they'll provide more debt, and they mean to provide more debt in relationship to their cash flow. What does that mean for the company? That they can get, you're dealing with just one bank, but the because there's more risk, the pricing will be higher. So if you look at the paradigm from a single bank through direct lending, there's more risk through that paradigm, and therefore the interest rate that you'll be charged will be higher. The last type of loan we'll talk about, Mike mentioned asset-based lending. This is a little bit different. Now we're talking about working capital assets that we use to borrow against. What are we thinking about? We're thinking about borrowing against accounts receivable, borrowing against inventory, right? And why are you focusing on that? Because a lot of times, and this is not going to apply so much to life science and med tech companies, because life science and med tech companies, for the most part, once they start generating revenue, their revenue is pretty consistent throughout the year. Asset-based lending, you're going to see more on seasonal type businesses, such as the retail, such as clothing, where you have peak sales in the fourth quarter. You have to build up that inventory, so you have to spend all that money to build up the inventory, and then you have your sales in the fourth quarter. So there's a capital need. So you borrow money in the second and third quarter to build up the inventory, and then as you make the sales, you pay down the debt. Look, we've talked about licensing and assets and royalty financing and IPO and SPACs. I think we've done a pretty good job of covering all that. And again, once you're a commercial business, you have access to all these sources of capital, from debt to equity. And if you're successful getting there and you're running a commercial business, the sources of capital are endless. I think we've covered pretty much everything we want to cover. If there's any other questions, we'd love to hear them.
Well, guys, that was fantastic. I don't see any other questions in there, folks. If you have a last question, get it in. If not, we'll recommend, please do reach out to Chris, to Mike, or to Rock or myself, and we'll get you plugged into the right resources. Not seeing any other questions, so I think that's a good place to wrap it up. Mike, Chris, I want to say thank you. That was awesome. I learned so many things right there, and I think the companies did as well. I hope everyone who's out there who participated enjoyed the session, and we'll have another one, I'm sure, coming up soon. Rock, I want to say thank you as well for, as always, helping to organize.
It was quite a
Thank you, Greg.
pleasure. I think this is actually the last workshop of the series that we did in 2021.
A good spot to end it, eh?
It is, and very happy, very glad. We've had very positive comments from the companies. Très heureux, comme je disais, c'est le dernier workshop atelier de l'année qu'on fait avec Medical Alley. Nous sommes en train de considérer refaire l'année prochaine parce que les commentaires et ce que les gens en retirent est très, très important. Non? Très content. Thanks so much, Michael and Christian. Can't wait to meet you. Christian, we've had a couple of coffee meetings that just didn't come true yet, but in the new year, it will be right up there on the to-do list. Thank you also for mentioning Resi and Biotech Showcase. I do remind everybody that we have very interesting packages. Just look at my LinkedIn page or the events on the Investissement Québec International.
Can I just make one final comment, and then I'll let Mike close this out. Both Michael and I will be out in San Francisco for the JP Morgan Healthcare Conference. If anybody who's never been wants to get more information about it, it's not about just our conference. As Rock mentioned, there's the Biotech Showcase, there's Resi, and those people seeking capital, whether angel investors or clinical or preclinical companies seeking their Series A or Series B, it's a great place to be. And even if you haven't set meetings up as yet, it's always good to go out the first time to get your feet wet, figure out what's going on, so that the following year you're much better, much more capable of figuring it all out. But we're here to help, and that's all I want to say. So feel free to reach out. We're happy to help.
I think we'll end it on that. Thank you, guys. Really appreciate the time. Frank, Rock, appreciate the partnership. We're open for any comments or any help that we can provide. So have a good day.
Thank you.
Thank you, everyone. See you guys.